Exxon reporting earlier this morning, earnings coming in at $1.95. That was 7 cents below the street's expectations. Came in at revenue of $82.91 billion. That was better than the street was expecting. Company saw record quarterly production in the Permian and in Guyana, and its highest second quarter global refinery throughput in the last 15 years. Exxon says that it's still on track to deliver $9 billion in structural cost savings by the end of the year compared to 2019. Joining us right now for an exclusive interview on the numbers is Darren Woods. He's the chairman and CEO of Exxon Mobil. And Darren, welcome. Thank you for being here this morning.
Good morning, Becky. It's great to be here with you.
So the talk among all of the oil companies has been that profits are down from a year ago. That's come as commodity prices have come down too. But when you look at it, you see that this is still a pretty strong profit when you're looking at second quarters historically.
Yeah, I think that's a really good context to look at the earnings. If you compare it back to 2022, you'll recall we were at record high gas prices. Gas prices were 3 times what the average was. Refining margins were 7 times what the historical averages were. Crude prices were up 40% versus historical averages. So a really high year last year, and frankly, a year that wasn't good for consumers, not good for economic growth, and frankly, for the medium to long term, certainly not good for the industry. So I think we're heading back to a time when margins and prices are more consistent with historical averages, but we're still in a fairly constructive market or positive market. Refining margins are still higher than historically averages. Gas prices, natural gas prices, still a little bit higher. Crude's about where historical averages are. So I think we're back in a better place, and demand looks pretty robust. Frankly, we feel real good about the value that we're delivering in this, what I'd say is a more normal market. If you look at a similar period in history back in the second quarter of 2018, the profits, the earnings that we delivered this quarter are double a similar price environment back in 2018. So feel really good about that.
Why is that?
You know, all the work we've been doing, and I've been on the show talking about the structural improvements, been a lot of reorganization, streamlining the business, cutting out cost, recapitalizing the business, investing in advantage projects, investing in technology, basically trying to pull every lever and take advantage of the competitive advantages bring to bear, the scale, the integration across our businesses. As you know, our headquarters is now here in Houston. So for the first time in the corporation's history, all of our senior leadership team is on the same campus, the same site. That changes the dynamic. I think improves collaboration, gives us all a better line of sight to the opportunity, and improves alignment. So not only have we delivered significant improvements over the last 5 years, we've got a clear line of sight for a lot more in the future.
One of the numbers we were looking at, just earnings $7.9 billion, that was excluding the identified item associated with additional European taxes on the energy sector. How big of a hit is that, the European taxes on oil?
Yeah, this quarter, European taxes aren't particularly meaningful. It's basically there was some netting going on. We got some positives back on some tax refunds and some additional European taxes. So it wasn't a real needle mover in this quarter's earnings.
In the Permian, it says you guys had record volumes. You said that's because of technology being a key factor. What's the technology? What's it allowing you to do that it didn't before?
You may recall back in 2018, 2019 timeframe, we really challenged ourselves to bring the weight and the capabilities of Exxon Mobil into the unconventional development space, challenged ourselves to bring the technology organization that we have and the learnings that we accrued over the rest of the world to the unconventional. And what we've done is kind of moved our performance, frankly, from what I would say is middle of the pack in the unconventional space to the front of the pack with respect to the performance that we're delivering. We're bringing on production with much lower capital, much lower cost, and recovering more barrels than our competitors. And you see that in competitive data. That's down to the improvements that we've made in our drilling and the wells that we put in place, the fracking, some of the technology that we're using in the subsurface to characterize the wells. So there's a whole host of technical innovations that we're trying to bring to bear in the unconventional space. We feel good about, one, what we've delivered to date. And frankly, we see additional opportunities. We've challenged ourselves to double the recovery that the industry is capable of achieving. And in the unconventional space. And we've got technology in the field today that we're testing that we think gives us a good chance of doing that. So I remain, well, first of all, proud about what we've accomplished so far, but very optimistic about the future potential opportunities to even improve on what we've done.
Darren, there were for a number of years, there was sort of a whole mindset change on what shareholders could expect from the majors. And that was, a lot of buybacks, a lot of, getting cash back. It was almost like harvesting what you've built over the last 50 or 100 years and giving it back to shareholders. We just had someone mention that we're at 101 million barrels a day of usage or something globally. And in 5 years, this was someone talking his book, probably the OPEC Secretary General, but he said 105 million. Has your viewpoint changed on what your goal should be, or what what you should actually try to do? Has it changed? Is it no more about buybacks and dividends and returning? Is it about investing to produce oil for the next 10 or 20 years? Has it changed?
Well, I would say our view has not changed. And to your point, Joe, frankly, our emphasis has always been on continuing to invest in the business and make sure that we're bringing on competitively advantaged barrels to meet the demands.
Will it get to 105, Darren? Do you believe that? That's a lot more. That's going to take a lot more production.
I would tell you, I think this year we're going to see record high oil demand. I expect that to be then next year even be higher. So certainly in the short to medium term, there continues to be a significant demand for oil and the products that come from oil, primarily because the world is growing and economic prosperity is improving all across the world. I think one of the things that people miss when they're advocating to reduce the amount of oil and gas that the world uses is they're very focused on advanced economies or developed economies. Yeah. There's tremendous growth happening all around the world where the standards of living are a lot lower than what I think all of us are used to, and energy is going to be required to bring that standard up, and with that energy, demand will come for oil and gas.